What if I told you that the value of your money changes every single second, even while you're watching this video? Yes, the money in your pocket might be worth more or less, depending on where you are in the world. Sounds crazy, right? But that's exactly how exchange rates work. An exchange rate is simply the value of one country's currency compared to another. For example, if $1 equals 83 Indian rupees, that means you need 83 rupees to buy $1. Think of it like trading cricket cards. You exchange one thing for another based on its value. But here's the twist. This value keeps changing every day based on demand and supply in the global market. Now think about this. If more people want US dollars today, what do you think will happen to its value? Just like any product, currencies follow demand and supply. If many people, companies, or countries need dollars, maybe to buy oil, invest in America, or trade internationally, the demand increases. When demand goes up, the price goes up. On the other hand, if fewer people want that currency, its value falls. Imagine thousands of students going abroad for studies and buying dollars at the same time. Demand rises, and the dollar becomes stronger. So here's a question for you. If India exports more goods to other countries than it imports, what might happen to the demand for the Indian rupee? Exchange rates also depend on a country's economic strength. If a country has strong businesses, stable government, low inflation, and good job growth, investors trust it more. When foreign investors invest money in that country, they must buy its currency, which increases demand and strengthens it. But if inflation is high, meaning prices are rising too fast, the currency loses purchasing power. And when purchasing power falls, the currency usually weakens. Now ask yourself, would you invest your money in a country where prices are rising uncontrollably? Why or why not? Another big factor is interest rates. When a country increases interest rates, investors can earn better returns by saving or investing there. This attracts foreign money, increasing demand for that currency. Central banks play a huge role here. They control interest rates and sometimes directly buy or sell currency to stabilize it. For example, if a currency is falling too fast, the central bank might step in and buy its own currency to push the value back up. Here's something to think about. If a country lowers its interest rates, how might that affect foreign investors? Exchange rates affect your daily life more than you realize. They impact fuel prices, imported gadgets, foreign travel, online subscriptions, and even the cost of studying abroad. A strong currency makes imports cheaper. A weak currency makes exports cheaper and can help local businesses sell more internationally. So the next time you hear that the rupee strengthened or the dollar weakened, remember, it's not just financial news, it's a story of glob.